Monetary policy versus fiscal policy. What's the difference? Introduction. Monetary policy and fiscal policy are two primary tools used by governments and central banks to influence a country's economic performance. Although both aim to stabilize the economy, control inflation, reduce unemployment, and promote sustainable growth, they operate through different mechanisms and are implemented by different institutions. Understanding the distinction between these two types of economic policy is essential for evaluating their effectiveness in addressing various economic challenges. This article will break down the differences between monetary and fiscal policy, explore their respective objectives, and examine their respective roles in managing economic conditions. Number 1. What is monetary policy? Monetary policy refers to the actions taken by a country's central bank to manage the money supply and interest rates in the economy. The primary objective of monetary policy is to control inflation, stabilize the currency, and promote conditions for sustainable economic growth. Central banks, such as the Federal Reserve in the United States or the European Central Bank in the European Union, typically use tools like interest rate adjustments, open market operations, and reserve requirements to achieve these goals. This section will explain the key components of monetary policy and how central banks manage the money supply and influence economic activity. Number 2. What is fiscal policy? Fiscal policy refers to the use of government spending and taxation to influence economic activity. It is primarily the responsibility of a nation's government rather than a central bank. Fiscal policy aims to stabilize the economy by either stimulating demand during periods of economic downturn or cooling the economy when the growth is too fast. Fiscal policy can be either expansionary or contractionary, depending on the desired economic outcome. This section will explain how fiscal policy works through changes in government spending and taxation, and how these tools can be used to influence aggregate demand and economic growth. Number 3. Key objectives of monetary policy. The key objectives of monetary policy are typically to control inflation, manage employment levels, stabilize the currency, and promote conditions for economic growth. Central banks aim to adjust interest rates to influence borrowing, spending, and investment decisions. When the economy is overheating, central banks may increase interest rates to reduce inflation. Conversely, during a recession, they may lower rates to encourage spending and investment. This section will explore the specific goals of monetary policy, including how it seeks to maintain price stability and reduce economic volatility. Number 5. The role of central banks in monetary policy. Central banks play a crucial role in implementing monetary policy by controlling the money supply and adjusting interest rates. Through tools such as open market operations, central banks can buy and sell government securities to influence the amount of money circulating in the economy. They also have the ability to adjust the reserve requirements for commercial banks and set the discount rate, which affects the interest rates at which commercial banks borrow from the central bank. This section will examine the various tools used by central banks to implement monetary policy and their effectiveness in managing the economy. Number 6. The role of government in fiscal policy. Fiscal policy is implemented directly by the government through changes in public spending and taxation. The government can increase spending on infrastructure, social programs, and public services to stimulate demand in a recession. Alternatively, it can cut taxes to increase disposable income and encourage consumption. Governments may also reduce public spending or increase taxes during periods of inflation to cool down an overheating economy. This section will explore how governments use fiscal policy to influence economic activity and achieve macroeconomic goals such as full employment and price stability. Number 7. Tools of monetary policy. The primary tools of monetary policy include interest rate changes, open market operations, and reserve requirements. Central banks adjust interest rates to influence borrowing and lending behavior in the economy. Open market operations, which involve buying and selling government bonds, are used to adjust the money supply. Reserve requirements refer to the percentage of deposits that commercial banks are required to hold in reserve, which influences their ability to lend money. This section will discuss each of these tools in more detail and explain how central banks use them to regulate economic activity. Number 8. Tools of fiscal policy. The tools of fiscal policy include government spending and taxation. Governments can increase public spending to inject money into the economy during periods of low demand or recession. They can also reduce taxes to encourage individuals and businesses to spend and invest more. Conversely, to cool an overheating economy, governments can reduce in spending or increase taxes to reduce the demand for goods and services. This section will explain how governments use these tools to influence the economy, address unemployment, and manage inflation. Number 9. Timing and flexibility. Monetary policy is often more flexible and quicker to implement than fiscal policy. Central banks can adjust interest rates and conduct open market operations relatively quickly to respond to changing economic conditions. In contrast, fiscal policy typically requires legislative approval for changes in taxation or spending, which can take longer to implement. This section will discuss the timing and flexibility differences between monetary and fiscal policy, highlighting how central banks can respond to economic challenges more swiftly than governments can through fiscal measures. Number 10. Impact on inflation. Monetary policy is particularly effective in controlling inflation. By adjusting interest rates, central banks can influence borrowing and spending patterns, which can either increase or decrease the demand for goods and services. Higher interest rates tend to reduce inflation by curbing consumer and businesses' spending, while lower interest rates can spur demand and increase inflation. Fiscal policy, on the other hand, can also impact inflation, but its effects are often slower and less direct. This section will explore how monetary and fiscal policies influence inflation and how policymakers use these tools to manage price stability. Number 11. The interaction between monetary and fiscal policies. Monetary and fiscal policies often work in tandem to achieve economic stability. However, when they are not aligned, they can lead to conflicting outcomes. For example, if a government is pursuing expansionary fiscal policies, increasing spending and cutting taxes, while a central bank is tightening monetary policy, raising interest rates, the effects of each policy may counteract one another. This section will discuss how monetary and fiscal policies interact, how their coordination can lead to better economic outcomes, and the potential risks of misalignment. Number 12. Long-term versus short-term effects. Monetary policy typically has a more immediate, short-term impact on the economy. Central banks can change interest rates quickly to influence borrowing and spending decisions, which can have an immediate effect on inflation and economic activity. Fiscal policy, however, tends to have a longer time lag due to the legislative process and implementation time. While fiscal policy can have a significant impact over the long term, it may take time to see results. This section will compare the short-term and long-term effects of monetary and fiscal policies on economic growth, unemployment, and inflation. Number 13. Advantages and disadvantages of monetary policy. Monetary policy has several advantages, including its speed and flexibility. Central banks can quickly adjust interest rates and other monetary tools to respond to changes in economic conditions. However, monetary policy has limitations, including its ineffectiveness in addressing supply-side issues, such as structural unemployment or productivity growth. Additionally, excessive reliance on monetary policy can lead to unintended consequences, such as asset bubbles or excessive debt accumulation. This section will examine the pros and cons of monetary policy as a tool for managing the economy. Number 14. Advantages and disadvantages of fiscal policy. Fiscal policy can be highly effective in stimulating demand, especially during periods of recession, by directly increasing government spending or reducing taxes. However, it can also be slow to implement and often face political hurdles. Additionally, excessive government spending or high tax rates can lead to budget deficits, debt accumulation, and long-term fiscal imbalance. This section will explore the advantages and disadvantages of fiscal policy and its role in supporting economic growth and stability. Conclusion: monetary and fiscal policies are both essential tools used to manage the economy, but they differ significantly in terms of their implementation, objectives, and effects. Monetary policy is primarily concerned with controlling inflation and managing the money supply, while fiscal policy focuses on managing aggregate demand through government spending and taxation. Both policies play complementary roles in promoting economic stability and growth, but their effectiveness depends on the coordination between central banks and governments, as well as the specific economic conditions at the time. Understanding the differences between these two types of policy is crucial for evaluating their impact on economic performance and for making informed decisions about future economic strategies.